So picture this. You open your trading app and you see one of India's biggest banks, Kotak Mahindra Bank, just tanking. A sea of red. Your heart probably skips a beat, right? But was this a real market meltdown or was something else going on? Let's get into it.
Yeah, that's pretty much the question that shot through every investor's mind. You can just imagine the confusion, the panic, as people saw this blue chip stock seemingly vanish before their eyes. Is this a glitch, a crash? What is happening? And this was the number causing all that chaos. A drop of 80%. I mean, that's a figure that would make even the calmest, most experienced investor feel a little sick. A drop this big usually means one thing: catastrophe.
But here's the thing. Was it a real 80% crash? Or was there maybe something else going on? Because in the stock market, the headline number almost never tells you the whole story. Okay, so let's all just take a deep breath. This was not a real crash. It wasn't a real fall in the company's value at all. What everyone was seeing was simply a planned, technical price adjustment. No value was actually lost. Whew.
The real reason behind that stomach-dropping chart has a pretty simple name, actually. It's called a stock split. So what on earth is a stock split, and how did it cause so much confusion?
A stock split is actually pretty straightforward. A company takes its existing shares and just divides them into more shares. Think of it like this. You've got a pizza. You can have one giant slice, or you can cut that same slice into 5 smaller pieces. You still have the same amount of pizza, right? It's the exact same idea here. The total value of what you own stays exactly the same. And for Kotak Bank, what they did was a 1-for-5 split. All that means is for every one old share an investor had, they were suddenly given 5 new shares. Simple as that. All right, let's actually look at the numbers. The math is super simple, and it's going to prove to you that your investment was never, ever in any real danger. So let's break this down. Let's say before the split, you had 10 shares. They were priced at about 2,132 rupees each. That means your total investment was worth around 21,320 rupees. Okay, now, after the 1-for-5 split, your 10 shares magically become 50 shares. And to keep the total value the same, the price per share had to be divided by 5, bringing it down to about 426 rupees. So what's 50 shares times 426 rupees? Yep, still about $21,300. The value is pretty much identical. And this right here, this is the single most important thing to remember. I'm going to say it again. The total value is the same. That scary 80% drop was just the share price catching up to the fact that there were now 5 times more shares in existence. Okay, so what does this actually mean for you, for your portfolio? What really changes, and what, if anything, do you need to do? Well, here's the beautiful part. The whole process is totally automatic. You'll just see the number of shares in your account go up, but the total value of your holding will stay the same. And the best part? You don't have to lift a finger. You do absolutely nothing. It all just happens. But this kind of makes you wonder, right? If the company's value doesn't change and the investor's value doesn't change, then why even bother doing a stock split in the first place? Well, there are actually a few pretty smart strategic reasons. The main one is just affordability. Let's face it, a share priced at 400-something rupees is a lot more accessible and less intimidating for smaller investors than 1/2,000. This opens the door for more people to buy in, which in turn increases liquidity, meaning more shares are being traded, and that boosts the overall trading volume, making it easier for everyone to buy and sell. So, and this is so important, a stock split is just a mechanical change. It doesn't mean the company suddenly got more valuable or made more money. It's simply dividing that same ownership pie into smaller, more manageable slices. So, as we wrap up, what's the big lesson here? What's the key takeaway from this whole thing? Well, it's all about learning to look past that big, scary, attention-grabbing headline number. Let's just do one final recap. The things that changed were superficial. The price per share went down and the number of shares you own went up. But the things that didn't change are the things that actually matter: your total investment value and the fundamental health of the company. Those stayed the same. And really, at the end of the day, this is the golden rule of investing. Your real long-term success isn't going to come from financial tricks like a stock split. It's going to come from how well the company actually performs, its earnings, its growth, its innovation. So I'll just leave you with this question to think about. The next time you see a market headline that makes your heart stop for a second, are you going to panic? Or are you going to take a breath and dig a little deeper to find out what's really going on?